We're live for a very special podcast episode today. We have two very special guests who are joining us from two different corners on the planet. We have Joachim, who's joining us from Amsterdam. Welcome, Joachim. It must be early morning for you at this time.
It's a little early, but I guess if you're on the West Coast, waking up at 5 or 5:30 is normal course of business.
And Thomas is joining us all the way from New Zealand.
Yeah.
Welcome, Thomas. Great to have you today.
Great to be here.
And essentially, what we are sort of really excited about is to have a conversation with Joachim and Thomas about their latest fund. They're both general partners in 432 Legacy, which is a very interesting fund, which is targeting the media and entertainment industry or the creative industries. One of the things that we would love to understand is really about the journey. We will cover also the key areas of focus. One of the very exciting aspects for a lot of new technology companies that are entering the entertainment space would be to understand the thesis that's really guiding the journey for 432 Legacy. And just have a very exciting conversation about a lot of change, a lot of disruption, and all the opportunities that both of these gentlemen are seeing. Joachim, Thomas, again, a very warm welcome from the entire Vitrina community. As you know, we have 100,000 people that typically are part of the Vitrina extended community. These folks are leaders in the entertainment supply chain, right from content financing to studios to production houses, distributors, technology companies, streamers, broadcasters, and everything that's in between. And one of the places that I'd love to really start off is really an elevator pitch for a fund. And if you can give us a little bit of a background about the fund, that'd be a great place to start.
Sure. I'll start from holistically. So the way we approach the fund or venture in that perspective is really starting at its most global, like on a global market view, to hone in on where bottlenecks exist due to sort of disruption taking place within that market that we're focusing on. And for this fund, we started out really looking at the content stack and how that's being disrupted. But as we progressed, Thomas, the latest iteration that we did really looks through the lens of how can we basically safeguard human creativity in the age of AI, and what does.
Wow. That is fascinating, and again, I mean, there is just so much of change and disruption, largely with technology that's coming in. One aspect was to also sort of unpack a little bit about the journey itself. You know, what was the aha moment in your sort of journey as you sort of started out and said, "Hey, this is a really exciting opportunity."
Yeah, and are you specifically referring to the fund itself, or like what we do in the background?
Actually, a bit of both, because you know they're so interconnected, and you know maybe it would be a great way to sort of unpack that as well.
Let me start because Thomas is sort of a big piece in this, and I think our aha moment is very different from Thomas's. So I followed a pretty traditional path, started in consulting, found out I wanted to be on the other side of the table, started my own company, raised some money. I went through a boom and a bust cycle, got into turnarounds, moved all over the world, got introduced to the world of tech when I was living on the West Coast, and then about now, I think it's about 5-6 years ago, started a first venture fund. And in that journey, sort of with Mike, the other GP on this, we focused on very much on like what should venture look in the future, and how can we remove more bias from the equation of making decisions. Mike had some experience in his previous fund using simple algorithms to help with scoring and then looking at deals and founders. But we also quickly realized that this is not a journey we can be on our own. What we want to do is way more complex. I grew up with a father in venture, so I've seen venture at its most traditional, super network-based variant. And and our paths crossed through a very good mutual friend between Thomas and us, Sarah, who sort of introduced us. And the aha moment for us was first to really realize like this is not like what we want to do. We cannot do on our own. And I'll leave it to Thomas to fill in the blank there.
Sure. A lot of blanks from my side. So I'm a data scientist. I've been in venture capital almost 20 years now, and my focus was really around trying to bring computational tools into venture capital, which still is pretty rare, but it was even more rare a couple decades ago. I think one way to describe it would be my specialty was to try to bring big data approaches to startups that have no data. So that's a special form of suffering I signed up for. And there's no magic crystal ball. I'm not saying that the machines have all the answers. But we do try to say through interesting approaches computationally and data mining wise, can we get any insights at all that help us as we look through the startup landscapes and try to figure out where to allocate capital? So it's more about trying to get advantages than trying to have a machine predict the future with perfect clarity. I will say the work has evolved iteratively as we've found one useful thing which leads to the next and so forth. And it's a very slow build. Most of the experiments we do don't work, which is no surprise. But really the focus has culminated into thinking a lot about value chains in a big data sense. So looking at systems like media and entertainment and rights management and entertainment, and these are very complex systems with all different types of value chain segments, all types of cross dependencies, and trying to understand how can we use a big data approach, for example, to understand these value chains, not just the supply chain, but the broader sort of Michael Porter-esque value chain way of looking at the market, and understand those dependencies and value drivers and try to figure out where is value created, where does it flow, and what kind of impact does it have, and using that to guide the investment dollars that we put to work. So trying to find value concentrations in the systems where there's much more demand than supply, where we might be able to find a really disruptive startup that we can get behind and hopefully not just make money on the deal, but have a more transformative impact in the system as a whole to try to move it forward in ways that we think are good for business, but also just good for the industry itself and the people in it.
That's fascinating. And again, it's a topic very close to my heart. Vitrina is a supply chain player. So when you talk about both supply chains and the extended value chain, I think this is a very, very exciting focus area for the fund. I was actually also wanting to understand the specific aspects that really drove you towards entertainment and creative industries. And what was the key insight? Was it the scale of disruption? Was that also part of a model output that you looked at multiple sectors and said, okay, this one is perhaps going to be the most disrupted industry? Because if that is the case, that would make this pretty interesting again in so many ways.
Well, I have a mix of motivations. I'd love to hear yours, Joachim, as well, because we've talked about it. But it'd be interesting to force you to take a moment. For me, of course, I've always been fascinated by the entertainment industry. I'm not an expert like everyone, like you are, and everyone else listening to this. So I'll be the first to admit I'm the noob in the room. But it's a fantastic industry in that it's incredibly complex and has been disrupted by technology many, many times. So from an external scientific perspective, it's a fascinating petri dish to begin to study just because of the complexity, and both the tangibles and intangibles are almost set to level 11, if you will, compared to a lot of other industries that are much more tangible. And one of the things I've noticed, of course, there have been so many subsequent big and small disruptions in the industry and reshaping of how it works. And a lot of those, it's no surprise, there are winners and losers as those phases come through. And I do think there's value throughout the chain. And I think everybody needs to get paid and to make money and to do what they need to do. But I can't help but notice that the value is drifting almost perpetually away from the creators themselves, the artists, the musicians, the designers. And I'm always interested in trying to figure out how can we affect these systems through investment, because that's what we do. We're venture capitalists, but in ways that can also help bring some of that value back to the artists. And I think that's personally, my daughter is a fabulous musician, and I'm getting to go through this vicariously through her. But she can't just be a musician anymore. She has to be a musician. By the way, she's only 17. She has to be a musician, a producer. She has to be her own marketing department. She has to have her own distribution and licensing management. She's tracking royalties. It's incredible. This is something that a singer 30 years ago would never have entertained. So as these changes happen, they ask new things of participants in the value chain, but also how can we do this? How can the system evolve in a way where the pie gets bigger and more value goes back to the creators so that everybody can do better? What I'm seeing is a very disturbing erosion and a commoditization, of course, of the content producers themselves. So they'll make the content, everybody else makes the money. And I think perhaps there's a better way we can approach that.
Thomas, that aspect is going to resonate with so many folks who are listening to this podcast. So again, this is something that is a core belief now with a lot of production companies, independents, and creators. So, but that's a fascinating insight. Joachim, if you can also sort of throw a little bit light on entertainment, why creative industries?
Yeah, the way, so except for being sort of a consumer of entertainment, my entry into the world of entertainment is actually through one of our investors in both this one and the previous one, and also a venture partner, Alex Sharding, co-founder of Miro. Together with him, we started a small production company. So I got people together and we started on this traditional path of creating a film. And one of the key moments, there were two that sort of struck me is we had a conversation with a very experienced Hollywood financier, and he showed one thing is he showed me sort of a breakdown of a fairly successful film, 150 million in revenue, and starting so that's revenue, and then I looked at all the way at the bottom. It says like what went to the actual production company, let alone the director. It was like 3 or 4%.
Yikes.
My goodness, that's not net profit. That's gross revenue for the creative company itself. So that's wrong. That, and Oleg was also very much like, how is this possible? And then the other aspect was it that also the way then that content in general, or especially film, gets financed, it is not a very sustainable way of financing. It is going from one bag of money to the other. That is how financiers in film are seen. And I think if you look at how the world is evolving, and indeed, as Thomas said, like, creative talent now needs to do so much, but also, I think the opportunity there is that because the world is more connected and all of these tools, the ability for us to, tell stories and find its niche audience and understand how much should we make this for so that it actually becomes a at least break even or net profitable piece of story that can be told is quite important, because in the end, storytelling and creativity is what makes us human. And if creativity can't be rewarded anymore, that's not a world I want my grandchildren to live in. So that's the underlying sort of realization of also the responsibility we have as venture capitalists. Yes, we are in this to have a very successful sort of investment strategy,
Right.
but the direction where we direct those dollars should also be taken into account much more beyond our own, let's say, back pockets.
Got it. No, that's a fascinating thesis again, and I think it really sort of talks about the soul of 432 Legacy as a fund, just in terms of what's guiding your journey. One aspect that I've always been struck by is how little does Silicon Valley really understand the content industries. They don't. I mean, I can tell you that VCs in the valley just don't get it. And again, it's from that perspective, 432 Legacy is quite a specialist player, because there aren't too many funds that really specialize in the creative industries. Well, would you agree with that?
Yes, although we can't, I think, Thomas, we can fairly say we are not a specialist in content.
All right.
And this is where the sort of what the infrastructure that Thomas has built helps us massively, is that without needing to have that super specialist knowledge, because you can't oversee it all, we are able to understand the value chain of this market through a specific lens. But then it takes into account data, infrastructure, security, integration tools, talent. And that makes us sort of have an ability to understand this market in a way that takes away the human bias, and it would be as if you have 1,000 sort of McKinsey consultants at your beck and whim, but I would say better, actually.
Okay.
Thomas, yeah.
Well, no, I really think there are a lot of parallels between the mission we're on and our approach and Vitrina, to your point earlier. We're both trying to bring more transparency and ask different questions and use technology to shed lights on different parts of the industry to figure out where is that value and make that something more accessible. And that allows value to be discovered and redistributed to those who claim it and capture it and have the creativity and the passion to do so. We're looking at these value chains and their complexity. But I think it's very similar to what I see Vitrina doing as well, right? You're allowing these people to break through the incredible information asymmetries that exist in the industry.
That's right.
Created by complexity, frankly, and opacity. And suddenly there's more opportunity for those with the innovation attitude and the drive to go capture it. So it's fascinating how these tools allow us to do that, both you and us in our own way, focusing on the same problem and different ends of it. And that's to me, again, I've been working in some version of AI. We wouldn't have called it that, but for almost 20 years. And it's great, actually. The word AI, the geek in me cringes even saying it because, of course, we could debate and whiteboard and argue all day about whether each piece is AI or not, or is it ML? Who cares? Now I can just say AI, where 4 years ago I had to spend an hour even trying to explain what it was. So at least we have something short and sweet. But I think about that, of course, we can't ignore the elephant in the room that it's here it is now in the entertainment and media industry and changing things in ways. And I think one approach is to say, hey, we're just going to see how it all plays out. And that's typically as the passive viewer. And I think something we're both you and I are trying to do in our different ways is say, or do we want to lean in? And do we want to do our best to try to help shape that to what we feel is a better outcome? Yeah, you can make money doing that intelligently, but what's the impact we really want to have? If we could either watch it happen or try to shape it for outcomes that are maybe better for everybody.
That's I totally understand that. And again, going back to the to something that you said, Joachim, the model can actually be applied to any value chain at a real Uber level. You've just decided that the first industry that you sort of focused on at this time is sort of the creative industry. Is that the right way to frame it?
Yes, it is. It's also core to how we believe, sort of, it's in the name, right? 432 stands actually for 432 hertz, which is a way to tune a musical instrument. But also there's a lot of symbolism around them. One of them being resonance, harmony. And what we try to create is that sort of between the triangle of the investors behind the fund, such the GPs and the portfolio we're investing in, that we're all aligned on why we're doing what we're doing. And it just creates a very different conversation rather than traditionally venture capital would be, thesis, some flashy things like, trust me, give me your money. We are actually like, we are opening the black box of what, the mysticism, because we can actually exactly tell you why we're doing what we're doing, what niche market segments we're looking at, what is happening within them, why it's a good moment in time now to look at companies, and then surface every single company, even remotely affiliated to that market segment, to understand how each and every one of them is performing in the market. Like, how is the market basically pulling on those companies? And that's quite unique.
That is fascinating. So let me unpack that a little bit on the data side and the approach side. Right? So essentially, you're looking at specific breakdowns or opportunities inside a value chain, and then looking at which companies are really doing exactly the solutioning. I mean, at a very simplistic level, that essentially is one of the aspects that the data does or the model does. Is that the right way to frame it?
Yeah. To unpack that a little more. So we have a data center, roughly 100 servers, a full team, data scientists, and all we do is try to figure out what can we see in markets that kind of helps our decision making and gives us more advantages. The sort of the journey, if you will, we would typically today start by looking at the value chain and all its complexity. So imagine hundreds of nodes, lots of interdependencies, and using really aggressive industrial scale data mining capabilities that we have in-house to do that. Then once you have this massive value chain, figuring out where are those bottlenecks, where are those constraints and control points, where in a company, if they can alleviate those control points, has outsized value capture and influence. Ideally, if you can capture the bottleneck, everyone else around you has to start paying some kind of rent. So finding those bottlenecks, finding then another piece of the stack, so to speak, is to be able to harvest all the companies globally that are working in that space. So who's in the bottleneck today, which companies, big or small? And of course, we're focusing on startups in the early side because that's our fund. And sometimes you'll go through a bottleneck and there really aren't any great startups out there, and you pass and you move to the next. So it's not as if you find one every single time, but the ability to figure out where to focus, find all the companies, and then quickly evaluate them through data signals, through AI, and really identify who's gaining all the traction and creating all the value. So you may have 5 startups, or you might have 50, and we're able to see which are winning effectively and growing their value at the highest rate, independently of how much money they're raising or whatever is on PitchBook. So we have our own bottoms up way of estimating value and growth, and it lets us cherry pick the winners. So we start with the value chain, go to the bottlenecks, find all the targets, cherry pick winners. And those are the ones where we lean in, and we do a number of analyses, as you'd imagine. But one of the key things we do at that stage is actually reach out to the startup and start talking to them. So all the work I've been describing is effectively pre-work we do to micro target who we want to talk to. And we already know who they are, what they're doing, and what effect we think is interesting about them. And then, of course, we'll go through, then it starts to look like a very normal venture capital conversation. We'll talk to them. We're figuring out if they like us, we like them. Are we aligned? Are they raising money? They might not be. Are they the stage we like? If conversations are great, we'll do typical due diligence, which is very thorough. So there's a lot more that happens outside of the servers and the data center, but we find incredible efficiencies and advantages by being able to do that front end piece incredibly effectively. And we're not relying in our fund on our deal flow based on our personal networks and how many planes we can get on and how many cocktail hours we've been to. It's irrelevant. I can sit in New Zealand, where I am today and where I live, and I can source startups globally in any industry or micro targeted bottleneck segment that I want and find the winners and call them. So it's a very different approach with a lot of advantages, but still the humans have to do the final yes. So if the AI says no, so to speak, we don't veto that, because that means there's a good reason and we would understand why. We wouldn't just blindly say no. But if, let's say, the AI has nothing but green lights, yes, 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 only the humans get to say the final yes. That makes sense. So we are truly a hybrid, looking for advantages and efficiencies, but we're not a quant fund by any stretch.
Because that's indeed, to pick up on the human side, what this allows us, this data approach allows us to do, is actually spend more time where it actually matters. And that's the founder itself, or him or herself. Because they're the ones, especially at, from C to Series C, they are the ones that are actually going to make it happen. And where traditionally you would have to, have 50 or 100 very in-depth conversations to do one deal, we can say, well, only these 3 matter in this segment that we're looking at. And if it doesn't click for one reason or other, then we're just not investing there. And we'll move on to the next. But it's, it allows us to really spend time where it matters. And that's, the personal relationship. And that's also an area where we go very deep again, where the data side, of course, is very quantitative. This becomes very qualitative.
Got it. So I'd love to sort of, go a little deeper into the bottlenecks themselves. Again, value chains are incredibly complex. And then even when you get the global dimension, the value chains, especially in this industry, because they've organically developed over years in different islands of countries, they've actually grown very differently, and they've taken a shape of their own in every market, right? In that sort of myriad of, mini value chains that exist across different markets and different segments, how do you define a bottleneck? And how does that get surfaced as a bottleneck? That things are stalling, collapsing, or there is a log jam. I don't know what kind of different bottlenecks there are as well from your perspective.
Yeah, good question. So for me, fundamentally, we're looking for imbalances between supply and demand. And so we'll start there, but I'll try to get to the rest of your question as well. So if, for example, you find a segment of the industry where there's far more supply than demand, that's, from an investment perspective, not an especially interesting place to invest, because there's commoditization, there's saturation. The market has provided adequate solutions for that segment of the value chain. So we're going to stay away, because there's, on the other hand, you might find a segment where supply and demand are pretty much balanced, where you have equilibrium. Those two, from an investor's perspective, we'll stay away from, because again, there's not a huge arbitrage opportunity. But where you start to get more demand than supply, especially in more extreme cases, that's where we start to look and get more excited, because now we're finding that the world needs solution. There isn't enough of something. So if you can find a startup that really is disruptive in that space, now you're looking at a really good, favorable set of conditions for an investment and for the startup, and also for impact, because bottlenecks, the system can only move forward as fast as its slowest parts. So by loosening those bottlenecks, you can help the industry move forward. And of course, the bottlenecks then shift to somewhere else. So this is not a static thing in these value chains. Values like an air bubble. It just sort of moves around to different segments. And sometimes it'll stay in a segment for 6 months. Sometimes it'll be 40 years. So you have to take that into account. What's the timing? Is the bottleneck regulatory in nature? Is it, if it's hardware or something, is it capacity? Is it labor? So they all, once you find those arbitrage parts of the market that are favorable, then that you dig in and try to figure out why, what's causing this bottleneck, and is it even something actionable? For example, if it's a regulatory artifact, we may not, as venture capitalists, be able to affect that. Certainly not directly. So that might be an example where we just say, okay, we're not going to put our investors' capital here because we don't see a way through. But there's somewhere where really you do find that magic combination of lots of demand, strained supply, and some really interesting disruptive startups that have cottoned on, that have smelt that opportunity and are building something interesting.
Fascinating. I wanted to also sort of understand the communication between what the data is saying and then how the fund actually acts on it. So how does that transaction happen? Let's say between the two of you, how would you relate that there is a bottleneck and there is an opportunity and there could be an arbitrage?
Yeah.
And
Well, yeah, go
Yeah.
ahead. I was going to say, so imagine you do this analysis, we could find 40, 50 bottlenecks of
right,
varying severity in one market. Then you start prioritizing how critical they are, how actionable they are, the time frame. So you end up with, let's say, a short list of a dozen or something, or maybe 10. At that point, we've all as a team been thinking about this and sharing this information. And we've gotten to those to say, okay, these are the ones we're excited about. Now we'll go again, harvest the data to find all the target universe. We'll start looking through them as a team. We have a battery of analytics that we're going to throw at these poor startups before they've even met us. We've already done all this workup. So by the time we've got it down maybe to our top 3 that are the right size, the right time, the right place, and we send them an email or call them or reach out to them, the team understands that whole journey and why we're reaching out to them in the first place. But the idea is it doesn't take us months to do this. It doesn't take us a year. This is something we can do as a team in days. So the beauty of all that infrastructure and the AI is that it helps us get there. And the long part is then once you do reach out, it's more conventional timeline. We try to move quickly and be very decisive. And I think we're good at that. But the whole team's part of the journey. I don't feel like it's a baton pass. If it is, we're passing it back and forth quite a bit as we get down to the, maybe we need a different metaphor, but that's what it feels like in practice.
Yeah, it all starts, I think we spent initially the most time is like, where actually do we want to, what's the lens through which we want to look?
right,
What's the input into this? And from there, the output then is, well, Thomas was sort of said, 50 or so bottlenecks. Well, we've one analysis where we have 75 of them. And and then it's all about indeed understanding them. And what helps a lot is to sort of also sometimes we see a bottleneck with the full reasoning and even going into the systemic impact of it. And from that, we can create, and that's where we actually use LLMs. Before that, we don't. To create a report, to also have conversations with experts in the field, like, hey, is this what you're seeing as well? We think this is a problem. We think that, a startup solving that problem should look like this.
right,
So it helps ground what we see in the data in reality. And then, as Thomas said, we go through this process. Okay, let's check. Like, there's M&A activity in the vicinity. There's enough momentum going. There's enough there, right? If it's, as Thomas said earlier, if yes, we've identified a bottleneck, but there are a couple of companies in there, then maybe it's just too early to look at it.
right,
Let's pause and look at that in the next sprint, because we can operate in sprints. But then when we do reach out indeed to the very handful of companies or less, we approach them with a level of insight and understanding about not only them, but their market, their universe, their clients. As a founder, you haven't been on the other side of the table. They don't need to explain us why they're doing what they're doing from a market point of view or from an opportunity point of view. We understand their entire competitive landscape often better than they do themselves. It really becomes a more like, why do you do what you do? Like, what's the intrinsic motivation as a founder?
Yeah, the founder conversations are critical, and I think it is interesting because I've been a traditional venture capitalist without these tools, so it feels like a long time ago. But as opposed to sitting in a room hearing pitches and getting your gut to tell you something, which is I guess a broken clock can be right twice a day. You can do some firms are very good at that, and I wish them all the success in the world. But the nerd in me always felt like, okay, I gotta do better than that, right? How do we start ratcheting up the yield and improving it? And that was the motivation behind all this work. And I think that when we reach out to a startup, we already know a lot about them, to Akim's point, but it's generally not a call of pitch us. It's, hey, we're fans. First of all, we just want to verify, are you really doing this? And if so, how? Because what we're seeing is incredible. That doesn't mean we automatically invest, but it just starts the conversation in a really interesting way. And usually we'll share all this data and insight. That's part of it. Even if we don't invest, we'll say, here, this is how we found you. Do you want to know your origin story from our perspective? And even if we walk away not doing a deal, I find it's just such a fun engagement for both sides. And nothing makes me feel better when they say something like, wow, I've never had a VC conversation like this before. This was actually fun. And I think, great, me too, because that shows that there's value exchange and we can do it without the ego and the judgment. We both have businesses to run. We want to know if it's going to work.
Right.
So we also, though, what I think can be frustrating for entrepreneurs in this approach, though, and I think it's worth saying, is we basically don't do inbound deal flow. We don't need to, and we don't put any effort into it. So we're not out there trying to get startups to come email us and pitch us. We'd actually prefer that they don't, because we'd rather have the conversations with the ones we've already vetted through our initial screening. It doesn't mean that we'll never take an inbound. Sometimes they happen and sometimes they work. That's okay. Right. But I do think the good part of our approach from an investor's perspective is all the virtues we've been talking about. The bad part is it's very hard to action as a startup. What do you do? It doesn't solve a problem of how do I get in front of more VCs and raise money. If they all did it the way we did, I think that would be really tough for entrepreneurs. I'm not advocating that as the end-all be-all solution for venture capital. For us, it works, but I can't, in my mind, resolve how frustrating that would be for startups if everyone did it.
Look, Thomas, I can vouch from a Vitrina perspective that, all of what you said happened with us.
Oh, cool. Well, that's good to know.
We got that call from the fund. We got the love and the appreciation and the confirmation that we were actually on the right path. So from that perspective, I mean, I can absolutely vouch for the fact that, and those conversations were incredibly pleasant. Just in a lot of cases, one of the issues that happens with founders, especially in the entertainment and creative sectors, is that a host of VCs just don't get it in terms of the industry, the pain points, and what you're really trying to solve. This was a very pleasant conversation because, there was just so much of understanding of exactly what we were trying to solve, and the scale of the problem, the scale of the opportunity, and also the appreciation of our efforts. So again, I can vouch for that, and I'm a big fan of that whole process and the method. One of the things that I wanted to actually sort of go into was really share a couple of observations and then see how would the data and the fund really take an opportunity from it, right? So in 2021, in 2022, post-COVID, we were seeing massive disturbances in the supply chain, right? As Vitrina, we were seeing massive increase in animation services demand, where a lot of sort of work was having to be offshored by companies in Hollywood or Canada. We saw then that entire opportunity move to VFX and post-production, where a lot of content was getting produced and then it had to be post-produced. And then there was this big logjam of no post-production capacities available. And then it moved a little bit later to localization because there was so much international content that was going on. It had to be localized in local languages, and you needed either service providers or technologies to really do this at scale and at a good value. I was sort of wanting to sort of see what kind of examples, seeing if there are some examples that you're going to sort of relate to, saying that, okay, this is what we saw, and it's confirmed or it wasn't confirmed.
Sure. Well, I don't know how nerdy you want to get on this podcast, but I mean, if I look at an analysis we did of, again, just a piece of this value chain, and again, I'm not the industry expert here, so I'll probably just embarrass myself, but just an example on the licensing and syndication part. I'm just looking now at my other monitor. Automated cross-platform content fingerprinting and real-time licensing engines. Right now, we're seeing there's a bottleneck there. You have a few proprietary big players and the demand is higher. There's a backup there. Again, we would need to look at What's the time frame likely to be? What are the different levers that might be able to be pushed and pulled? And are there some startups in there doing something interesting that's disruptive? But I wanted to give that example. First of all, it's germane. You asked, that's the one we found. You and your listeners can agree or disagree, but that's what we found. But also that's the level of specificity we're talking about here, where of course this isn't sort of licensing is bottleneck. We can get down to very granular, very technical components and technologies in the system where we're seeing challenges pile up. It's one thing to talk about big ideas, but for the engineers and scientists on the front lines, it's the highly granular technical issues that are the real problem. It's not ivory tower. It's I can't get X, Y, or Z. And understanding what those are at that level of granularity and even beyond, even those are the kinds of things that we're looking at. And you are too, actually, fairly at Vitrina a lot of the time.
That's right. That's right. And in this particular example, by the way, that example resonates a lot. Again, we are seeing massive log jams in transactions in that area. One aspect was that once the choke point has been identified, then is there a valuation of how big is the scale of the problem, and then I'm guessing you're sort of moving to identifying which are the players, which startups are trying to sort of play in that zone.
Correct. You got it right. And we are going to look at those bottlenecks carefully, and the details are going to matter.
Okay.
But honestly, we've found to learn empirically is a little counterintuitive to venture capital in that I'm not actually looking for a big TAM, a huge market. And I know that ultimately I want a startup that can grow and find a big market. But as the beachhead, because we're doing early stage, I really don't care that much about the TAM. What I really care about is it the right beachhead for this startup? Because frankly, if it doesn't survive the first 5-6 years, it's not going to matter anyway. Yes. So is this the right starting point? And then does it have an ability to build from that and to enter adjacent or bigger markets? So we use the island hopping metaphor. We don't want to invest in startups that are going head to head with big incumbents attacking a fortified castle, because it's much easier for incumbents to defend the castle than the startup to take it away. It's not that it can't happen. Statistically, it's a terrible outcome. You don't want to play those odds. And we're all statistics in our fund, right? So instead of finding startups going right at big competitors with their swords out, another strategy is for the same startup with the same technology that let's just metaphorically find a little uninhabited island, and you show up, you rock up with your boat, you plant your flag, and you're king or queen. So, and then you build a little village and you find another uninhabited market and another and another. So if you get enough little islands together, you could end up with Indonesia. So the TAM can be huge. We're not interested in startups that are trying to take Indonesia on day one, to stretch the metaphor. So are your beachheads really high odds and where there's a lot of tension that breaks your way, that's going to be a wind to your back? And then can you then leverage that? Now, it's one thing if you have a startup that can't, and sometimes we see those. They can capture an island, but that's it. Those, as a venture capitalist, we can't invest in. They could be great businesses, but our investors expect much higher returns. But as long as we don't have to, as long as we can imagine or really get a credible sense that the technology can scale to other markets, it could be lots of small markets, and that's fine. That's what we get excited about too. So it's counterintuitive, because I think a lot of founders have been told by VCs that they have to have this huge TAM, this huge number, and they make it up. Everybody can make a number. I don't want to talk about that. I almost don't care. What's your first step? What are you going to do first? And what does that look like? And could you take a second step if that works out? And that's how we approach it.
Understood. One aspect that I was also curious about was relating to tech-enabled startups, sort of creative sort of startups which are more in the creative zone, vis-a-vis also any geographical sort of markets that are of specific interest. I know that US is the world's largest market for entertainment, but what are the other aspects that you sort of look at within the space of new companies and startups?
Yeah, I think maybe to say is like we don't specifically look at a geography. It doesn't matter where a startup is from. We want to see it if it's there. If it's solving this bottleneck, we want to see it. So we are not bound by, it needs to be the US or it needs to be in the UK. That doesn't filter into the initial sort of assessment of the startup.
And from a tech perspective, any thoughts relating to, again, there are lots of startups which are coming in with generative AI, lots of sort of startups that are also spinning up, on gaming engines to, create new content, just blending multiple technologies, generative AI, gaming engines, and other tooling. Just how do you look at that entire emerging space?
I'll give you my bias. I don't know if Joachim shares, but it may be a good time for us to make sure we're aligned on that. I, in principle, do not care what technology the startup's using. I don't care if it's blockchain. I don't care if it's AI. I just, frankly, irrelevant to me. What I care
Hmm.
about is this business in an interesting place doing something disruptive with a good business model there. Now, again, as part of diligence, if it's blockchain, we're going to have to check out and make sure that that's legit or stands up. So, but we're not thematic around the technology components. So
Right.
because here's the challenge, and part of why we've taken this value chain and bottleneck approach. I mean, it obviously has some merits, but before we had this capability, I was always had this anxiety, and I almost didn't know how to articulate it. But you'd see in the old days, you'd see a startup, they would pitch you, and a lot of times they'd be nice, bright people with great ideas, and you like everything about them. But the nagging question I had was, does the world need another one of these? In other
Right.
words, today I would use the language, are they effectively entering a market with excess capacity or equilibrium where the supply and demand are not tense? Because the world might not need another startup in excess capacity land, no matter how
Hmm.
good it is. And I
Hmm.
just had no way of knowing. And I would try to guess and you try to think through it, but it was really hard. Short of commissioning a consultant to do a 6-month study in the old days, it was very hard to do. And you never would do that for a deal. So I'll give you an example and I'll just look up from my screen again. If I look at something, I don't even know 100% what it is, UHD grade edge content delivery network capacity, there's a part of the value chain that apparently is in excess capacity. There's plenty of supply. It's outstripping demand. If a
Yep.
startup came up to me and just seemed amazing, but they were in that segment, I would pass today because to me
Right.
that's just not what's going to move this whole thing forward. So I hope
Yeah.
that gives a little bit of sense of our North Star and how we use this.
And maybe to add to that, like we tend to look for sort of the picks and shovels,
Hmm.
the B2B enabling technology companies that in general, the characteristic of those companies that they might have a slightly slower sort of uptick,
Hmm.
but they're building more sustainable value.
Right. Right.
One could maybe shoot through the moon, but are very
Yeah.
hard to judge whether they actually survive in the long term. I think we've touched upon this a couple of times, and Thomas said we're all about statistics. We try to, with every step we take, filtering down until we get an investment, is increasing the probabilities of that we're in the right place, the right time, with the right founder, tackling the right problem,
Hmm.
and that journey continues post investment as well. In the metaphor of island hopping, we can be part of that conversation because we provide a continued sort of evolving view on their entire industry, the landscape, how it's changing, which in go-to-market or product decisions can be essential.
Fascinating. Fascinating. No, I think that makes a lot of sense. One aspect that I was very curious about, and again, we touched upon some of these aspects, but if you can go a little bit more, maybe under the hood, there are multiple different verticals even within the creative industries. You've got music, you've got video, you've got gaming, publishing, perhaps, right? Which are the ones which are the most exciting from everything that you're sort of seeing from the data, saying, oh my god, like there is a massive amount of disruption, opportunity, logjam? What kind of comes to mind, or is it even Kevin right now?
Yeah, so I guess the first, Thomas, the first analysis we did was actually from the lens of how all of these stacks, the way these pieces of content are created, are converging. Like they're no longer very separate in the technology stacks, but they're becoming more and more one. And that was actually the first value chain analysis of the industry. How does that look like? Where are the bottlenecks in that from that perspective? So that's a
Beautiful.
little bit how we
Yeah.
look at it, like going beyond the now, but more in 5 to 10 years, what does that world look like? And I think it's more converging than diverging.
No, that's fascinating, and again, resonates with everything that we're seeing in terms of market moves and market movement that's happening. As we sort of coming to the last section, I was wanting to sort of really understand about the fund itself. How you sort of thinking about the fund, what stage is it in right now, and then also what kind of LPs have really gravitated towards it. Are you raising in the US? A little bit, if you can unpack that a little bit. about the fund itself?
Sure. So we've just started raising for this fund. We have some initial investors behind it. As in our previous fund, like investors can be from all over the world. We both look at the US, Europe, Southeast Asia, Japan. I think we have conversations with anyone from entrepreneurs, high net worth individuals to very sophisticated, large family offices. And what we see is that especially those with a good sense of data science or have experience on the public markets on the quant side, they really get what we're doing. They click on this approach. And but what's more important for us is that what they learn from the engagement they have with us is that we can build relationships with them that go beyond merely this fund. We can, over time, as we get to know each other better, cater to much more specific ideas that they may have as a family office or where they want to direct capital. I think for us also the exciting opportunity here is that right now we're looking at this world of entertainment and content, but the way this can be applied, we can take actually very social issues, but understand the economic value chain behind it, and that's very unheard of, I think. Go ahead, Thomas.
Yeah, I love that. And this is my perspective, not necessarily the whole team's perspective, and they've had to endure me. But when it comes to investors, the thing I'm actually looking for is people who really genuinely care about the domain that we're in. But for the ones that they do, and talking about alignment, I really only want investors that really care about the subject matter, the theme that we've defined. And there's plenty of money out there. And I was laughing because poor Joachim, I basically rejected this really large investor the other day and I felt terrible about it because the person did not care about the thing. And I'm just like, no, I don't want, and they're like, well, we've got all this money. And I'm like, I don't care. We don't want that money. We want people who really share the common cause. We're going up a mountain together and we need a team that wants to do that. And look, I think investors and us and startups, you have to think about it as a team. I know that might sound a little bit cheesy. We all depend on each other. We only win if we all win. And so you want people that care about the outcome. Yeah, we all need to make money. That's a given. That's what we spend all this effort doing. But just assume that we will. We have to care about the outcome in more than financial terms. Otherwise, I don't want to waste my time. You could do a venture fund on anything. We could be a generalist fund and make money. So what? I don't care about that. I really want meaning, and I want people who share that meaning. And that's an interesting fund and something that's worth our time and our effort and our passion. Just like an entrepreneur, right? We're not mercenaries saying, yeah, we'll just do anything and anywhere with anyone. And I think to me that's what makes this have impact. That's what makes it endure. That's what makes it successful financially and otherwise.
Right. Actually, my next question was going to be, what is an ideal partner from your perspective? But you've kind of addressed that. I don't know, Kim, if you want to sort of add to aspects that Thomas talked about.
No, absolutely. It will be great. Like right now, if we look at sort of the people that I would say we have two categories of investors right now. Those that fall squarely into the category that Thomas mentioned, like they're in this because they want to see something change. And there are those where we sit that actually look at how we do ventures. That is really interesting. That is special. That is distinctive. They see how that is actually repeatable without being super dependent on me or Thomas or as an individual, more as a collective. And they look at this as a get to know you exercise, but like the bulk, and that's where we are going for, that the bulk of the capital that we raise with this fund should indeed be from people that have either affinity with the industry, that are from the industry, that really see the change that is needed and believe in us and when what we show them, that this is a way to accomplish that.
Right. And exactly, if they understand the domain, they know exactly what's really happening, all the transformations that are happening. They're kind of wanting to go through the journey to create opportunities for the investee companies, for the fund, and for themselves as part of that entire ecosystem that you guys are creating. That makes a lot of sense. Is that the right way to frame it?
Well said. Yeah, you said it better than I did.
Okay. No, this is great. This has been very, very exciting. In fact, the one aspect that I can absolutely see is that even a host of tech entrepreneurs who are entering the creative industries for the first time, don't really have that domain understanding, and only an ecosystem that really believes in the industry and the disruptions and which aspects are really to be sort of harnessed from an opportunity perspective. A lot of them typically would love that support base from 432 Legacy.
I hope so. I hope so. Well, thank you
Fascinating.
so much. This has
Yeah,
been a
this was great.
pleasure.
Thomas, Joachim, this has been an absolute pleasure. It was great to actually sort of, know your plans as well as really go in depth on the thesis. This was a wonderful, wonderful conversation. Thank you so much for making the time.
Delightful. Thanks for
Yeah.
having us.